Good afternoon, everybody, and I'd like to thank AFM for giving me this opportunity to come and speak in front of you. I just have 20 minutes, so I'd like to keep it short and sweet. In 20 minutes, there is that much justice you can do when it comes to an incredible topic like this. So let's see how it unfolds, and let me see if I can do justice to such a large topic today. I do believe that we are a gathering of advisors, and I'd like to address it both from an advisory perspective as well as from the asset management side. When we look at this basic industry over the last few years, the industry has evolved dramatically. And I'd just like to flip one slide, which we use normally for investor presentations, where we put the risks associated and look at the underlying market growth. I'm just flipping it aside and showing you the basic changes that have evolved in the industry and how have the assets grown. If you look at the changes, and most of them have been regulatory in the last few years, while these changes have been significant, what has happened is if you look at the underlying industry, the assets, that's the orange line, has just kept on growing. So most of the impact of these regulatory changes, or what bothers us, which I call mostly the noise, is actually resulting in a dramatic increase in the industry over the last 10 years. The graph has just skyrocketed at a 90% sort of trajectory. And you go a little further and you look at it, in the last 5 years, our 10 lakh crore industry has gone to 25 lakh crore, 15 lakh crore added in just 5 years. That's how fast the industry has grown over the last 5 years. Yeah? Let's put that in the backdrop and see one of the most effective changes that I feel has happened to the industry. In December 2016, our industry was practically owned by corporates. 56% of that industry was being owned by corporates, and in just 3-4 years today, our industry is owned by individual investors. And that, I feel, is the biggest impact that the industry has put forward. Finally, we are becoming an industry which is being owned by individual investors. Please understand, when we talk about the product mutual funds, it's probably at the bottom of the pyramid on wealth creation. Evolved products like PMS and alternates are ahead of us. So we are a diversification product, and it is meant mostly for individual investors, apart from providing corporate solutions at a shorter end to the treasuries. But that's how it plays out globally. But I'm so happy to say that in the last 4 or 5 years, the way it has penetrated into the individual investors segment has been pretty commendable, and that reflects on the change or the evolving nature of the advisory in the country. But what has changed? When you look at the broad industry, what has basically changed? There has been a dramatic change in the last 1 year, and we'll like to bring the elephant out into this room and discuss that change a bit. Because before we go into that change, let's understand our roles. What is our basic role? And I do believe whether you are an advisor or you are an asset manager, the basic role remains the same. It is a fiduciary role for both of us. Please understand, our raw material is money. Our raw material is not our money. It is somebody else's money. And that's the basic role. We are the safeguard to somebody else's money, and that is why our roles in this area is phenomenal. It's a very important part in the society at large. This is the power which, if we carry on forward in a good way, it gives us incredible satisfaction from a job satisfaction perspective. And then come to the basic change which we have seen in the last few days. What has changed? And I do believe the basic change that we are talking about today is the SBI circular which came and hit the market. It changed the entire landscape perpetually. You know, I am reminded earlier when we used to start presenting, and I started selling funds in 97, 98. Those days we used to have that slide projector, and we used to change that plastic foil change. And suddenly there was this new projector, and we got out our the presenter slides, and there used to be this red light with which we used to point out. But today what has happened is that the basic screen behind us has changed. Yeah? And the old slide presenter does not work. So this is the first time I upgraded to the new projector, and I am able to show you this. This is what has happened to us. Our underlying, on which we were working till yesterday or till October 22nd, has changed now. And life after 22nd of October has changed permanently, because When it is a SEBI circular, it is the law. It is a regulation. And the regulation is black and white. There are two types of people. There is the lawmaker and there is the law follower. Okay, we are law followers. And when we put that in perspective, there is no interpretation to this anymore. It is in black and white, and we have to follow whatever is in black and white because that is how it will be going forward. And that is why the subject becomes a little important right now. It is no longer an AMFI best practice under which we were guided by. It is now a SEBI regulation. And what are the implications on that? I'd like to spend the next 15 minutes on that. But when you look at the impact of this, and that's the involvement of the industry, and look at the industry over the last 10 years. In 2008, the basic distribution landscape was like this. You know, you had the banks, the national distributor, institutional distributors, the regional distributors, and then there were the IFAs. Right, formed a big part of the market. Come to 2019, this landscape is divided into two parts. Yes, there is the MFD and there is the RIA. Two large pillars developing, and within these two pillars, the five exist. Right? There are the banks, NDs, private wealth, institutional distributors, IFAs, and we have a new channel coming up, the online channel, where the MFDs exist. And then you reflect on the new castle which is forming, and that is the RIS, which also has all of them. Right? Look at it from an asset manager perspective. Asset managers used to get money only in this part. Now, the distribution broad basing has been dramatically changed. There are RIAs who are IFAs, there are RIAs who are banks, there are RIAs who are national distributors. Over and above this is direct. Sometimes we confuse direct to be a big part of what is RIA. So the point I'm trying to make is direct business involves RIA money as well as direct investors coming to us. Please, let's not confuse that as all direct being direct investors coming to us. A big part of direct business is advised business today. If I were to give you our basic data, out of the 100 rupees that comes into Mirae Asset on the direct side, 78 rupees is RIA advised money. That is the impact at the underlying. Please don't, I just want to leave this behind on the table because when I go onto the online world, there is a lot of discussion which is not true about the direct investor coming in. A bulk of it is advised money, right? When you look at the basic impact of this, and it's playing out in the industry, I do believe, and that's not for mutual funds, it's about any industry we go to, an investor above a certain level talks to the manufacturer directly. If Sahara Star were to buy TV, they would not go to Vijay Sales. They would call for all the manufacturers to come to them and do a price bidding. That is what happens on the institutional side on any business. A fleet owner does not go to a dealer to buy trucks. He goes to the manufacturers directly. Similarly, in our business, the large institutions come to us directly, and that is why the institution side of the business is broadly direct. But what is interesting to see is that 13%, and I'm just bringing the elephant out of the room because this is normally not discussed, or if it is discussed, it is not discussed in the right spirit. 13% of retail is also direct, while big part of retail remains with IFAs. The HNI space is also broadening up. 22% is already, this is the AMFI-CAMS report, which came out at the beginning of the year. So it is, all this data is available online, so you can get this online. So what I'm trying to say is that the flow of money at the underlying is changing, and my humble request to the people in this room is to respect each part of the money flow and not look at any part of the money flow as any threat or wrong or right. Every money which comes in comes at a certain merit, and time will only decide whether that merit is correct or not, right? But when you look at the flow, and it is dramatically changing, look at the flow change between 13 and 19 in 6 years. What used to be a 23% direct is 42% direct. IFAs used to be 16% of the market, are now 14% market, not because the IFA flows have changed. This component has, mathematically this has changed. Broadly, if you go to the first slide, we've added 15 lakh crores in the last 5 years. So the pie has increased for everybody. And hence, there is space for all of us and probably more in the coming times. Yeah. Moving on, there has been the other impact on October 23rd, 22nd is the categorization. And what has categorization done? It has brought about two things. One, it has flattened the definition of all funds. So what is mid-cap for us is mid-cap for everybody. There is no interpretation to that term anymore. The number two point which you have to keep in mind is the TRI impact on the returns of all the funds. And let's look at that data in the right perspective. And data never lies. Most of us, when we look at equity returns, just 4 or 5 years, our projection was 15%. And when you reflect on the last 10-year returns, the industry average for large cap on a 10-year return is 11%, mid caps is 14%, contradictory, small caps is 12%. I'm just taking a pause for everybody to take that in. Small caps actually underperform mid caps on a 10-year horizon by 2.5%, right? Of course, the multi-cap, the evergreen remains 12%. So the multi-cap category is actually performing as good or as bad as the small cap category, which under present market condition is not looking very logical. But this is data, and data does not lie. Just to carry this discussion a little deeper, and that's my favorite slide going out into the market, because post-categorization, this is what has happened. And the diversification between returns within a category is there for you to see. It is a staggering difference. Typically, we brush all categories one brush. Abhi mid cap karne ka hai, then small cap karne ka hai. But see the diversification. And then the second thing that I'm told in my selling career is in the short run, there is volatility, long term mein sab theek ho jata hai, right? Theek hota ki nahi, let's look at that side. I mean, if you look at that, on a 10-year horizon, the minimum return of a large cap fund is 7.5%, 7.35. The highest is 15.5. Let's go a little deeper. On a 10-year horizon, there's a mid-cap which is given you 8.24, 8.24 CAGR on 10-year, and 17.7 on a 10-year. That's the highest performing mid-cap fund. Small cap is 8.29, highest is 18.4, and the multi-cap difference is 8 and 17. If you come to the bottom line, and the bottom line is, there is a difference of 13.7% on an average between the minimum performing fund and the best performing fund in each category. CAGR 13.7% is the effect that you will give to your investor if you catch the wrong fund, right? That's the flip side, because going forward, if you look at the way it unfolds, this is the key to everything. Which fund are you catching? Why I say this? Because post October 22nd, a thing which has come into light, and let's look at the two NAVs which are in front of both of us. There are two NAVs now, regular and direct, right? In the regular, let's look at the charges. There is management fees, which is common to both. Yeah. There are other expenses which are common to both. There's a Carvi expenditure or a CAMS expenditure. And what is the differentiating factor between the two NAVs? Brokerage, right? I'm so happy that we have that clear. No, there is one more, sorry, my apologies. There is the investor education 2 basis points, which is common to both. And then the difference between the two NAVs is the brokerage or the sales and distribution cost, right? There's this famous slide of Carl Richards which said there is investor return, then there is investment return, right? Investment return and investor return. I've just flipped that slide and I'm calling this the advisor gap. This is what you bring to the table, right? The expectation from a basic investor or an advisor from a fund manager is to beat the benchmark sooner or later. And when we don't beat the benchmark, we are questioned about our price that is charged or the TRs or the cost of the fund. Sooner or later, this will also unfold between you and your investor is my submission. Take it in the right spirit. I'm just leaving it as it is. Because when you look at the growth of all of us in the future, and this is common to both you and us, the future remains very simple. Our earnings now depend on the growth in NAV. Right? Sometimes we confuse it to the brokerage we negotiate. Brokerage is incidental. If you catch a fund at 15 rupees and it remains 15 rupees or it goes down to 12 rupees, in the trail regime, your income actually comes down. If you catch a fund from 15 rupees has the capacity to go to 30 rupees, even if half the trail, it will make you more money. And that's the new business now. When you reflect that to the previous slides and you look at the growth in NAV as being the deciding factor of the growth of all of us, then scheme selection becomes the most important criteria for this business going forward. There is nothing else in this business. How to select a scheme is a separate discussion. If you call me back, I'll come and discuss that. It's probably take a whole day. Okay, and we'll reflect a little bit on that in the next slides. Because when we look at the flows of the industry, and scheme selection is flow funds, right? Where is the money coming from? If you look at 16, 17, we sold mid-caps dramatically. Right now, we are selling small caps very heavily. And suddenly, there is a dip in small cap, and the money is going to large cap, suddenly, in 1 month's time, right? The large and mid-cap is probably stable. The arbitrage has started getting some money. ELSS, though we believe is a consistent flow category, but the ELSS still continues to get money only in the month of March. It is still, in my father's or my parents' time, March, our salary or take home in my house used to be nil. We knew in March there was no money for us. It still remains that even after the evolution of the industry. When you look at the debt side is even a disaster. There is no consistent category which gets money categorically. When you look at both these slides, and these are available for you to, what you will, to get anywhere, what you will conclude is very, very dramatic. The weightage of past performance in selection of scheme is paramount, number one. We only sell past performance, number one. The more disturbing factor is the past performance is restricted only to last 1 year performance. So the category which has performed the best in the last 1 year gets the maximum money. This happened in 2017-18, we sold mid-cap like there was no tomorrow, and we are selling small caps like there is no tomorrow at this moment. Not everybody needs small caps, right? Or not everybody needs mid-caps. It's an asset allocation game. But the data says that this is what we do, right? And I'm just giving you data, nothing else. To come to some basic conclusion on this data is that industry is yet to discover the category called large and mid-cap. Our view is that there is very little to differentiate between the large cap category and the multi-cap category. Both run, the large cap is 80% large cap, the multi-cap category is 75% large cap. The differentiated category, where you look for that proverbial multi-cap category, will be the large and mid-cap going forward. And the industry is yet to recognize that, hence there is no flow in that category. Yeah? Selling balanced fund through the monthly income route, while we knew at the time of selling it was a disaster and is coming down to haunt us dramatically, the industry is losing 2,000 crores per month as we speak. But when we sold it at that moment in the balanced fund category, we knew it was wrong, but nobody cared. We sold nearly 80,000 crores in that category for a period of time. But now, as we speak, 2,000 to 3,000 crores is going out of the industry every month, right? And selling on past performance still remains paramount. That is the conclusion. The good part of all this, which I have not mentioned, and that's known to all of us, probably the best part that has come out of the last 3-4 years is the SIP story. And that's a phenomenal story building, and credit to everybody in this room for supporting that the way it is going on. The way forward, I believe, is very simple. Yeah? It has to convert to a complete financial planning model. It has to move to what used to be just a transactional sort of advice to a complete plan. I'll elaborate a little bit more. It has to be solution-based rather than transactional sales. And this is across category. This is not restricted only to the IFAs. This is across category. I mean, sometimes people tell us, why should banks sell SIPs? Today, banks are large sellers of oil. Our highest SIP per month, and this has come in an SIP form, is a 3 crore per month SIP from a wealth management firm. Okay, and it's not 3 crores every, it's an SIP form. It's staggering to see an investor of that level committing to an SIP form. I thought it was an ego stage and why should a wealth guy sign on an SIP? But it is happening. There is, if we do not move to a complete solution-based advice, you are not going to be there in the market is a reality. And that is the only way forward. That is how the globe has evolved. As we see pressure on our earnings, the only way to retain them is to give a tangible to the investor. And only tangibles will differentiate a good advisor and a great advisor, is my simple submission to the merger. We have to move from what gets us good AUM, because that is how we are valued, jiska AUM bada hai, wo acha hai, right? To what I call is what will earn the investor. If the investor is not earning, you will not survive is a reality. And I'll take 1 minute from a Mirae Asset perspective. We know that the secret of success to Mirae Asset is only performance. I'm happy that it is consistent performance. I cannot stand here and play the victim. Why is that expectation from us? That's the truth and that's the reality. We have to build business around that reality for us to survive, forget being successful. That's the new life. You have to judge people on whether they are making money or not, whether a fund is creating money for your investor or not. Over the last 10 years, we have seen this big move on what is a great brand to what is a great product in our industry. And probably we are one of the biggest beneficiaries of that, so I thank all of you for recognizing that part. But the challenge begins now. Can we retain it is the question, right? If we are able to retain it, well and good. If we are not able to retain it, the consequences are known to all of us. And we are okay with those consequences. Yeah, this has to be the biggest change. AUM criteria does not matter. What matters is whether your investor is making money or not. If your investor makes money, you make money. If you make money, the AMC makes money. That's the flow chart. And that flow chart is universal. If something goes wrong in that flow chart, the business just goes down. Yeah? I leave the room with one, and I flip this question to all of you. When I ask this question, people get a little surprised. I'm asking a very basic question. And the answer is in front of you. What percentage of benchmark is outperforming active funds in the US? It's the other way around. I'm not asking active performing, outperforming. I'm asking what percentage of benchmark is outperforming active fund managers in the US? Look at the answer. This is S&P. It's, again, you can Google the site and take. On all domestic funds, on a 15-year basis, 88% of benchmarks outperform active fund management. On large caps, the number is 91%. This is US data. On all mid caps, it is 92% on a 10-year horizon. I'm talking about 15-year horizon, sorry. 92%. Benchmark outperforming. On all small caps, 96%. That means 15 years ago, all active advisors have been wrong. That's the truth. Imagine. Is it, you might say, ki boss, ye to US hai. Hame kya lena dena? Let's put out our slide. And I'll end with that slide. In India, on a 10-year horizon, 61% large cap. Benchmark outperforming active performance. On the ELSS, 45%. Mid cap and small cap, 48%. And I'm talking about 10-year horizon, okay? The short term is even more dramatic. On the government bond, 87% on the debt side. On the composite bond, 96%. If you had just bought the bond index and the 10-year GSEC, and this is the whole scenario. That means on a 10-year horizon, your chance in the last 10 years of getting a mid-cap outperforming the benchmark has been 50%. That means 10 years ago, that person would have been better off just buying the index than buying the broad claims that the industry makes. And this data will only grow. Data is already there, but it is in our subconscious. We are afraid to address this data. And again, I repeat, data does not lie. Right? I'm not scaring you, I'm just telling you the truth. Okay? With that perspective, I'll just finish by saying that these are two great gentlemen. As some of you might have seen this slide, this is my favorite slide. Every picture has an item number. Ye mera item number hai. These are two great individuals. Who are they? Sunil Chhetri, Mr. Metsi. Huh? Good footballers. One a good one, one a great one. Right? I leave that question to you when I say that a good footballer is there where the ball is. A great footballer is there where the ball will be. Yeah? Think about it. When you look at all the data, and especially the last two slides, yeah, imbibe the data. If you imbibe the data, you will become more successful. Face the truth, it is a brilliant industry to be in. Creating money for a person who already knows how to make money is probably the biggest thing that happens globally. Every individual in this room knows that his financial health is more important to him than his physical health. Right? And we cater to that. It is probably, and it is the #1 profession globally, and that is where we stand. But in often or not, we don't address the reality and we remain where the ball is. And in that, destruction happens. Okay? So I thank you for your patient hearing. Any questions I'm willing to take, but really appreciate, sorry if I've been a little blunt, but it is time to be blunt. Yeah? Thank you so much.